In September 2008, it was a nightmare financial crisis that shook the whole world. Today, the stage is set for something like this to happen again. On Friday, Jerome Powell's dramatic speech in Wyoming sent Wall Street into a panic, which caused the Dow Jones to lose a shocking 1,008 points. The Fed chair made it very clear that interest rates will keep going up for the foreseeable future, which has made investors very nervous for months. Some very influential people in the financial world had said that interest rate hikes would end soon, but that doesn't seem to be the case at all now. Powell not only put an end to these hopes, but he also said that there will be more trouble to come. When the markets open tomorrow, Wall Street will finally have to deal with the real world, and things are likely to get messy. In today's video, we'll show you that another disaster is coming in the financial world, and it's going to be terrible. Before we begin, if you haven't subscribed yet, please subscribe to our channel and hit the bell icon to get notified of our new videos. Last Friday, the Dow Jones fell a remarkable 1,008 points, which had investors on the edge of their seats. Some of the most experienced market players saw right away that there were a lot of scary similarities to the 2008 crash and the financial crisis that followed. In the past, when the stock market crashed, it often seemed to be a sign that things were going to get worse. For example, the Dow Jones Industrial Average dropped 777 points on September 29. 2008, everyone around the world was shocked. That was a new record at the time, and fear spread quickly through Wall Street. The following information comes from a CBS News report that came out right after the market crash. Wall Street watched with shock and fear as the $700 billion financial rescue plan blew up on Capitol Hill, sending the Dow Jones Industrials down nearly 780 points in the largest one-day point drop ever. Ted Weisberg of Seaport Securities said, "No one could believe it. It's hard to believe that it didn't get done." The result was a record-setting 777-point drop on Wall Street, and the Nasdaq fell almost 10%. The article also pointed out that the Dow's sudden drop showed how bad things were on the market. The blue chip index dropped by hundreds of points in just a few minutes. By the end of the day, it had broken its own record for the biggest drop in a single day, which was set on the first trading day after the 9/11 terrorist attacks. So many stocks were sold that only 162 went up on the New York Stock Exchange, while 3073 went down. Investors felt like they had no chance, and the fact that every part of the financial markets was falling at the same time made their problems even worse. It takes a lot of fear to cause such a strong reaction on Wall Street, and now everyone is worried that the financial sector, which is hurt by hundreds of billions of dollars in bad mortgage bets, won't be able to recover because no one knows what will happen to the $700 billion plan. CBS said in its report at the time that investors, financial strategists, and economists on Main Street were scared to death by a lot of strange coincidences. For example, when the stock market dropped 777 points, a 7-year Shimada cycle ended and a new 7-year Shimada cycle began. It almost seemed like there was something big and strange going on in the world. In fact, Rosh Hashanah began on September 29, 2008 in the evening. Throughout history, big things have happened on or near the timeline of major biblical festivals. After that terrible day, the world's financial markets went through some of the worst times in their history, and Wall Street lost all confidence. The meltdown caused big problems in a number of countries, and the U.S. economy went into what became known as the Great Recession. In 2015, almost 7 years later, there was another crash on the stock market. There was a lot of pain in the markets, but many people have already forgotten about those hard times. Now, 7 years have passed, and it looks like Wall Street is about to go through another big panic. It's interesting that it looks like another cycle is starting up again. The housing market had one of its worst days on September 19, 2008. The housing bubble burst in 2008, which is coming up on its 14th anniversary. Most people don't remember that there was another housing crash 14 years before that in 1994. And if we go back even further, the housing market was also falling apart 14 years before that. In 1980, it was a big drop in the market that caused home prices to drop. Now we can see that another disaster like the last one is coming. Another bubble has burst, and now the housing market is falling again. This crash could be the worst of all. Experts say that if the Federal Reserve stopped raising interest rates so quickly, we might be able to stop the real estate market from falling apart in a chaotic way. But that's not likely to happen right now. On Friday, Jerome Powell said that there would be more rate hikes and that everyone should get ready for more pain in months to come. In a keynote speech at the Federal Reserve's annual Jackson Hole Economic Symposium, the Fed chair said that lowering inflation would not be easy or quick, and that we would have to use our tools forcefully to bring demand and supply into a better balance. Investors don't like to hear that we use our tools forcefully, and it doesn't give them much comfort. During his speech, he said again and again that more trouble is coming. Wall Street didn't like the tone of the speech, so the sell-off sped up even more. This was because of the possibility of a long period of high interest rates, which would cause more economic pain. Powell used the words slowing economy and looming wave of job losses twice in his short speech. He also said that tighter credit conditions will inevitably hit American homes and businesses. He said that while higher interest rates, slower growth, and a weaker job market will all bring down inflation, it will also hurt businesses and households. Powell went on to say that these are the unfortunate costs of lowering inflation, but that the pain would be much worse if price stability wasn't restored. Powell is making it clear that right now, fighting inflation is more important than supporting growth by bringing up the lessons learned from the Fed's fight against high inflation in the 1970s and 1980s. In a research note, Jeffrey Roach, the chief economist at LPL Financial, said that Powell stressed that the Fed is not ready to stop or pause, even after 4 straight rate hikes, including one of 75 basis points. This is bad news for investors who thought the next rate cut wouldn't come until 2023. Investors are worried right now because they don't know if it will be a half point or 3/4 of a point next month. No matter what happens, it will cause more chaos on Wall Street and make the housing market crash worse. Jay Hatfield, who started and runs Infrastructure Capital Management, says that Powell's statement makes the chance of 75 points more likely. He made it clear that, in the meantime, what's going on in the derivatives market is also something important to keep an eye on. Alasdair Macleod, a financial strategist, recently wrote a very in-depth article on how the derivatives bubble has grown to almost unimaginable sizes, saying, in a time when credit is tight, over-the-counter derivatives are by far the biggest problem. There are commodity contracts, credit default swaps, equity contracts, foreign exchange derivatives, and interest rate derivatives that are not on a public list. According to the BS database, the notional amounts of all contracts that were still open in December 2021 were worth $610 trillion. There are a total of 70 dealers' returns in 12 jurisdictions that make up these positions. Together, they account for about 94% of the total covered by the BIS's Triangle Survey, which suggests that the real total amount of money out there is closer to $650 trillion. Most derivative dealers, like Cloud laid out, are parts of commercial banks. As bank credit gets tighter, this brings up 2 problems. The first is the effect on counterparties of a major bank failing, which almost always happens at this point in the credit cycle. This must be avoided by making sure that any bank with a derivative book is bailed out. The second is how much the banking sector decides to cut its exposure to over-the-counter OTC derivatives in order to lower its balance sheet leverage. He went on to explain, "There is no doubt that a recession is coming to the world economy right now. This change is due to the end of the long-term trend of interest rates going down, which in some cases led to interest rates that were negative. Banks used a lot of leverage on their balance sheets to keep making money, even though credit margins were getting smaller. This set them up for a huge loss if interest rate trends changed. This change is now happening. Previous currency and credit expansion has led to steadily rising consumer prices, which have been made worse by careless government actions that have caused a dangerous fuel and food crisis. For bankers who aren't controlled by their regulators, greed is giving way to fear that their shareholders will lose money. As interest rates go up, loan risks get worse, the cost of government debt and financing goes up, and commercial banks have to stop lending to Main Street. The expert gave a great summary. Wall Street will also be affected, which should come as no surprise. The problem is that when this derivatives bubble finally bursts, it will be a disaster for the U.S. economy and the global financial system as a whole. Analysts like Michael Snyder, who have been warning for a long time about the dangers of the derivatives bubble. But unfortunately, no one has listened to what they have to say. Now, it's just a matter of time before it falls. Powell and his colleagues at the Fed are doing things that could shake up the financial markets a lot. But Wall Street isn't ready for an interest rate shark, and everyone will soon realize that the government is making a terrible policy mistake. That's all for today. If you like this video, please give it a thumbs up. And if you want to hear more videos from our channel, subscribe and make sure to turn on the bell icon.